Your business did $1 million in sales last year. Sounds successful, right? But your credit cards are maxed out, your line of credit is almost full, you're behind with suppliers, you're worried about payroll, and there's barely enough money to pay yourself. So, where did the $1 million go? Here's the uncomfortable answer. A $1 million business can still be a financially weak business because sales can make you look successful while poor margins and cash flow quietly destroy you. Hi, I'm Us Melbourne, founder of Melbourne Accounting Solutions. Today, we're going to talk about one of the biggest illusions in entrepreneurship: revenue equals success. It doesn't. You can have tremendous sales and very little profit. You can have profit and very little cash. And you can have a company that looks successful to everybody else while the owner is financially struggling behind closed doors. Let me show you how it happens. Meet Michael. Michael owns a growing company. 3 years ago, sales were $400,000. Last year, $1 million. Michael is proud. His company has employees, vehicles, a bigger office, more customers, more equipment, more advertising. Everybody congratulates him. Michael, you're killing it. But Michael knows something they don't. Friday is payroll. His bank account has $38,000. Payroll is $42,000. And several customers haven't paid him yet. Michael owns a $1 million company and he's wondering how he's going to make payroll. How did this happen? Problem has shown. $1 million in sales is not $1 million in profit. Let's follow Michael's money. Revenue, $1 million. Now subtract the direct cost required to produce those sales. Materials, subcontractors, direct labor, freight. Other direct costs. Suppose those costs total $650,000. That leaves $350,000 gross profit. Already, $650,000 of the $1 million is gone. But we're not finished. Now, come the overhead expenses Michael still has: rent, administrative payroll, insurance, vehicles, advertising, software, phones, professional fees, bank charges, interest, repairs, office expenses, and dozens of smaller expenses. Suppose those expenses total $310,000. What's left? $40,000. Think about that. The company generated $1 million in revenue, but only $40,000 in operating profit in this simplified example. That's a 4% operating margin. A relatively small, unexpected cost could wipe out much of that profit. But it gets worse. Michael says, "Everald, if I made $40,000, why don't I have $40,000 sitting in my bank account?" Excellent question, because profit and cash are not the same thing. Some of Michael's money may be sitting in accounts receivable, inventory, equipment, customer deposits, or prepaid items may have their own accounting implications. Cash may also have been used for loan principal repayments, asset purchases, owner withdrawals, taxes, or other balance sheet transactions. Those activities can affect cash differently from accounting profit. Here's the part business owners need to understand. Suppose Michael has $180,000 in accounts receivable. That means customers owe the company $180,000. His income statement may already recognize qualifying sales. But Michael can't necessarily use an unpaid invoice to make Friday's payroll. He needs cash. That's why a business can appear profitable on its income statement and still experience a cash crisis. Problem #2, growth can consume cash. This surprises many entrepreneurs. They think, if I double sales, I'll have twice as much money. Not necessarily. Imagine Michael lands a huge contract. Before the customer pays him, Michael must hire employees, purchase materials, pay suppliers, rent equipment, pay fuel, cover payroll, and finance the project. The customer pays him 60 days later. Who finances those 60 days? Michael does. The faster his company grows, the more working capital he may need. So Michael can experience record sales, record growth, and simultaneously record cash flow pressure. Problem #3, small margins leave little room for mistakes. Suppose Michael's net operating margin is approximately 4%. Now imagine materials increase, insurance increases, employees receive raises, a customer refuses to pay, a vehicle needs a major repair. Or Michael gives customers another 5% discount to win business. Do you see the danger? A few percentage points can matter enormously when your margin is already thin. That's why owners need to know their margins. Problem #4, DEBT can make growth look easier than it is. Michael wants to keep expanding. So he uses credit cards, a business line of credit, equipment financing, loans. Debt isn't automatically bad. Used properly, financing can help a company grow. But here's the danger. Borrowed money can temporarily hide weak cash flow if your bank account keeps running low. And your solution every month is just take another $20,000 from the line of credit. Eventually, you need to ask, is the debt financing growth or financing a business model that isn't generating enough cash? Those are completely different situations. Now ask the question most owners avoid. Imagine Michael increased revenue from $400,000 to $1 million. But during the same period, his debt increased, his hours increased, his stress increased, his payroll increased, his receivables increased, and his personal income barely changed. Did Michael's business actually improve? Maybe, maybe not. Growth must be measured by more than sales. The numbers I want you watching. If your company is growing rapidly, don't only ask, how much did we sell? Start asking, what is our gross margin? Are we making enough from each sale? What is our operating profit? Is the business actually profitable after overhead? How much cash are operations generating? Are profits translating into cash? How quickly are customers paying? Are receivables consuming working capital? How much debt are we carrying? Is growth increasing financial risk? How much is the owner actually earning? Is the business creating economic value for the person taking the risk? Revenue tells you how busy your business is. Profit tells you whether the work is worthwhile. Cash tells you whether you can survive. You need all three: revenue, profit, cash. Confusing them can become extremely expensive. The $1 million test. If your company generates $1 million or more in revenue, I want you to answer these questions without asking your bookkeeper. What is your gross profit percentage? What is your operating margin? How much do customers currently owe you? How much do you owe suppliers? How much debt does the business carry? How much cash does the company actually generate? How much are you taking home? If you know the revenue, but can't answer the rest, you don't know your $1 million business as well as you think you do. At Melbourne Accounting Solutions, this is exactly the conversation we want more Canadian business owners having. Your accountant shouldn't only tell you your tax return is finished. Your financial information should help you understand where the money is going, which margins are shrinking, why cash is disappearing, whether growth is financially sustainable, and whether your company is actually creating wealth. If your business is doing hundreds of thousands or millions in sales, but you're constantly wondering, where is all the money? Contact Melbourne Accounting Solutions. Let's find the answer in your numbers. Here's today's CEO question. If my revenue doubled tomorrow, would my business become twice as profitable, or would I simply become twice as busy? Think carefully before answering, because sometimes more sales can magnify a bad business model. I'm Everald Melbourne, founder of Melbourne Accounting Solutions. Our mission is simple: to help Canadian business owners make smarter financial decisions, reduce unnecessary taxes, keep more of what they earn, and build stronger businesses. If you know another business owner doing huge sales but constantly wondering where the money went, share this lesson with them and subscribe to our channel for more Canadian business, tax, accounting, and financial insights. And if your company is growing but your bank account isn't, contact Melbourne Accounting Solutions. Let's determine whether your growth is actually making you financially stronger. Helping Canadian business owners learn, grow, prosper. Thanks for watching, and I'll see you in the next lesson.